All right, welcome everybody. We're going to give folks just a minute or two to get logged on here, and we'll get started with our webinar today. All right, let's go ahead and get kicked off here. Again, welcome everyone to the call. We are excited to be with you this first one of 2024. I'm Greg Patterson. I'm joined with J.A. Kennedy and Tara Gould, and we are with Atlantic Wealth Management here in Morehead City. And this is our first one of these webinars for this year. We did them last year, and we hope that it's going to bring you useful information and give you a chance to hear what's going on in the markets and hear what's on our minds. And we'd always welcome your questions. So if you do have those questions, feel free to email them. Mackenzie here at our office is collecting those, and we'll make sure that we get to you. Her email address is Mackenzie, spelled MACKENZIE at myatlanticwealth.com. And as always, we welcome your questions and feedback. And we've got about 30 minutes, so let's go ahead and kick it off. Let us just share a little bit of the agenda of what we're going to cover today. We're going to talk through 2023 from a very high level, look at market returns and see how those different indexes did. We're also going to cover some economic data. So each data point that we're going to discuss is updated about every 30 days. So we'll bring you that as well. And we're also going to take a look at 2024 and look ahead with our crystal ball, if you will, into what we think would happen here in this year. And then Tara's going to bring us some important information on New Year financial planning topics. We always try to include one of those in our webinars. And today we'll be looking at things you should be thinking of as you're planning for your finances here in 2024, specifically January and tax time coming up. And then we'll wrap it up with our conclusions and have you out of here hopefully by 4:30. And so first off, let's talk through total returns. Tara, bring us up to speed on how the markets did last year.
Absolutely. So at the beginning of the year, things were looking a lot differently than they did at the end of the year. I'm going to go through some of the indexes that we're tracking and following, and then we also have some exchange traded funds listed. And just note that indexes are unmanaged. We're not directly investing into those indexes. It's something that we track. With the exchange traded funds or ETFs, you can actually purchase shares in to those funds, which then mirror or track the index. So first of all, we have the S&P 500, and you can see what the December close value was. We do pay a lot of attention to S&P 500. It is considered the single best gauge of the overall U.S. equities market. It's of the 500 leading companies. And we know that these are mostly large cap. We will even often quote this as very close to the total value of the overall market because it represents so much. But what we're looking at is for the year. So we took the end of December of 2022 through the end of December, and the last trading day for the year was on the 29th of 2023. And we saw that percentage change of 24%. Next up, we have called it the DJA, or the Dow Jones Industrial Average. Again, this is another index. This is price weighted, and this is going to be 30 of what we would call blue chip U.S. stocks. We often don't quote the DJA as a good gauge of the overall market just because of that small sample size. But you can see what the December close was at. We were at 30,689.54, and that puts the percentage change for those companies at 13%. NASDAQ, really impressive. NASDAQ index, another staple of the financial markets. In NASDAQ, we have about 3,700 companies. It's going to be very heavily weighted, actually more than half in technology. So you can see the close of 2023 over 15,000, and that put the percentage change from December 2022, end of close, market close to end of close, December 2023 at 43%. Russell 2000, I know you've heard this one before, but a lot of times people are like, not really sure what's involved in that. So Russell 2000 is the 2,000 smallest companies from the Russell 3000 index. And the Russell 3000 index is designed to look at the total overall market. And so if we pull out those top companies, what we're left with is the mid and small companies. And so the close on the Russell 2000 was just over 2,000, and that puts the percentage change at 15%. Then let's take a look at, we call it the EAFE, which is Europe, Australia, Asia, and Far East. This is going to be of developed countries. So this particular index does not look at emerging markets. It's going to look at developed countries with the exclusion of the US and Canada. And this is also a market cap index. So market cap refers to just the total dollar value of a company's shares of stock outstanding. And so when you hear things like large cap stock, small cap stock, you can understand what that means. And so December close over 2,200 and put our percentage change at 18%. I do want to shift gears a little bit. I was talking about before, index versus fund. Here we're quoting the AG, which is an overall representation of what we call the Bloomberg US Aggregate Bond Index. And so this is going to be investment grade bonds. These are dollar denominated, does include some treasuries, government related and corporate securities, as well as mortgage or asset backed. So iShares has an ETF called AGG, which mirrors the Bloomberg Aggregate Index. The price here at the end of the year was just under $100, 99.44. So that puts our percentage change for 2023 at 2.5%. And then lastly, we have gold. Gold ended the year trading at over $2,000 an ounce, which put that percentage change in 2023 at 13%.
Just one note there. I mean, these are big percentage gains for the year,
Right.
but they are coming on the backs of 2022, which was a very volatile and negative year overall. So, and we'll talk about where we stand in some of these indexes today versus where we were a couple of years ago as well. But good year from a return standpoint.
Absolutely. And just a little bit more in 2023, if you guys can think back to the start of the year, we were coming off the year end of 2022 when we were seeing negative returns. And so as we came into 2023, the consensus was that recession was coming. It was imminent. The projected probability of a recession was very, very high, just not knowing what the Fed rate hikes were going to do to our overall economy. Experts were just kind of left waiting in 2023 for labor markets to turn. And so the consensus was that if inflation is going to be fixed, shall we say, that this was going to in turn hurt the overall labor markets. For money market yields, I know I talked with a lot of clients who were excited to see yields in that 5% range. We hadn't seen that in years. If you can think back to just a couple years ago when we were at less than 1%, it's difficult to find a money market account that was paying at 1%. So people are definitely excited about earning more on their cash. So what happened is cash started flooding into those money market accounts. And then by the end of the year, while people who were in cash, great, I earned 5%. Comparatively to the market, we saw the market increase 24% like we saw in that graph before in 2023. Most of this took place in Q4, so the last quarter of the year in 2023 was very exciting as the markets took off with the announcement of the Fed being close to or towards the end of those rate hikes or the rate hike cycle.
just a great point. Cash is safe, but there's always an opportunity cost. There's a
There
balance
is.
there.
There is.
Yeah, and the Fed paused on rates October, September, October, and December meetings.
Yeah.
So the market really fired up after that.
Responded well.
We wanted to review over this chart briefly. I like this chart. It's from the New York Times, and just when we think about what the experts thought would happen versus what actually happened for the year 2023 in these four major areas, just from an economic growth standpoint, GDP standpoint, projections were less than 1%, so 0.3%. And it looks like we're going to come in at around 3% or so annualized. We haven't gotten the fourth quarter number yet. So stay tuned for that, but somewhere around that. Big difference between 0.3% and 3%.
Mhm.
On the unemployment standpoint, Tara already mentioned this. Expectations were for unemployment with regards to the labor market to go up above 4%, so 4.8% there. Actual is 3.7%. And then we looked at this too, the S&P 500 projections for a 5% return was much greater than that for the year 2023. And then also related to the job market, just the thoughts that we would have a decline in jobs added per month, and actually added over 200,000 jobs per month. Some months more than that, some months less, but much different when we look at expectations versus reality, which quite often is the case when we look at the market and the economy. A couple other highlights, just looking at geopolitical stories from 2023. China, there were some expectations that China would step up and really have positive and standout growth, and that hasn't been the case. We, of course, had the spy balloon debacle with China, and then we're still talking about China and Taiwan and what happens. Does China become more aggressive? And then we also had the Hamas October 7th terrorist attack, Israel's response in Gaza, which we're still dealing with today. And then it's kind of hard to believe that we're almost 2 years into the Russia-Ukraine conflict, but that continues as well. The update there is there seems to be, some support being lost by Zelensky. I think in part because there's other conflicts like what's going on in Israel that are going on in the world. But I guess all three of these bullet points really spill over into this year as well, thinking about China, Taiwan, and the continuing conflict in the Middle East and Russia, Ukraine. So we'll maintain watch over those things into this year as well.
Yeah, I think it's important to note too, last year was probably the first year, maybe you heard some in 2022, but we definitely heard about AI, artificial intelligence, and the rise to the forefront, whether it's chat bots or just, asking ChatGPT to create a poem in the matter of 20 seconds. All those things came to be last year and are still at the forefront today. In fact, I think it's important and noteworthy to say the S&P 500, 26% of the market cap was made up of 7 companies. I think it was Bank of America that had coined the Magnificent Seven, or at least an analyst with Bank of America, Michael Hartnett. And this is Microsoft, Amazon, Meta, Apple, Google, or their parent company, Alphabet, NVIDIA, and Tesla. Those 7 companies, many of them have huge stakes in AI. And so we're seeing the benefit of that, and certainly saw it last year with the fourth quarter ramp up in the market, that S&P 500. But when you think about AI and artificial intelligence, there's a bright future there. Microsoft, for example, has a huge investment in ChatGPT maker OpenAI. And so we actually saw Microsoft surpass Apple last year as the most valuable company on the planet by market cap. So it's exciting to see whether it's the software behind this, the hardware in terms of chips with chip makers, NVIDIA, AMD, and others, to actually how we're going to use this as we go forward. And many have embraced it already. So just something we'll be able to look back to late 22 and 2023 to see AI emerge, and then how this will be used in the future. Also, CPI. This has come down. Consumer Price Index is a measure of inflation. And so you can see on the chart in front of you, all items is the blue purple line. And then the red line is all items less food and energy. So the numbers came out for the December update on CPI. It did tick up just a little bit to 3.4% year over year. So from December 22 to December 23, certainly down from the 9% high back in mid-year 22. And also a reason we believe that the Fed paused on raising rates for September, October, and December. And prices are under control. It doesn't mean that you're not still seeing higher prices when you go to shop for things that you use every day, but the rate of growth has declined on those since the summer of 2022. So we feel like this is positive progress, and it should continue to drop. Now, whether the Fed gets to the 2% target or not, I'm not sure. When we started the year last year, I think we shared with you guys that we'd probably have to see an unemployment over 4%, and we did not. So, but it's noteworthy that it is seasonally adjusted downward. And as far as go ahead.
I was just going to say that the trend on the food and energy that impacts that blue line is more volatile than that red line that takes out food and energy prices, that has been sort of more of a smooth downward trend. Mm-hmm. And so we would expect that to continue. Anything else you want to comment on inflation?
It's noteworthy that energy prices decreased 2% in 23. They went up, I think it was over 7% for 22, the year 22, but then they came down, which it does represent a big piece of that. So that's noteworthy as well. Now, I would tell everybody to get ready for your electric bills, because the cold weather we've had here, but I believe across the country as well, or certainly the East Coast, would make a difference there.
Agreed. Yeah, so we always want to just hit briefly just latest economic data, and Greg's already covered CPI, Consumer Price Index. PPI is the Producer Price Index. The same trend with PPI, it's actually running 1% increase year over year. So those producer prices have gone up less than consumer prices over the last year. On the employment front, unemployment, has remained under 4%. We're at 3.7% currently. We talked about how we've continued to have job growth, and jobless claims have maintained at a very healthy level. So we're within that 200 to 225,000 initial jobless claims number on a weekly basis. And the trend has been over recent weeks for that has actually come down some. So on the housing market front, this is kind of a similar theme that we've talked about on previous webinars. Housing starts are up over the last year, and that's because people aren't selling their existing homes. In fact, when we look at existing home prices have risen about 4.5% on existing homes over the last year, while they've dropped about 7% on new homes. So that's just the nature of the interest rate environment folks are less likely to sell their low interest rate mortgaged homes and buy new. Then we jump to retail sales, and this has been kind of another positive story where the consumer has remained fairly strong in light of the high interest rates. There was some question mark about what the December retail sales number would come in at with the holidays, but we had a 5.6% increase year over year, which was very positive. And that was the last retail sales number. Industrial production has been up and down on a month-to-month basis, but we're still slightly positive over the last year if we look back a year ago. So that's another point that we would look to and maintain watch over as we go forward. And then we've talked about economic growth, but measured from the standpoint of gross domestic product. We're about to receive the first estimate of the fourth quarter number at the end of January. But it does look like I've seen estimates in the high ones to mid 2% annualized range, which after the first two quarters at 2% or around 2%, the third quarter was almost 5%, 4.9%, should put us at that annualized mark of somewhere around 3%. So that is a very positive rate of growth for 2023. And then the Fed, the next meeting is the end of January. That would be next week. And so we'll, again, continue to watch the Fed and what their posture is as we head into this year. So that's kind of a high-level overview of the latest economic data. And that brings me to just 2024 forecasts. And I feel like as we've made our way along since COVID, dealt with high interest rate environments, economic and recession forecasts and market forecasts have really gone from being on a shorter spectrum to a much wider spectrum. And I think we can see that in just the headlines. So I've tried over the last month or so just to clip headlines as we've gone along. This is from the beginning of January. This is Larry Summers who says the economy looks strong. That's his take. But then we can look at Bob Dahl's 10 predictions for 2024, and he thinks we're in for a mild recession, and he sees unemployment going up to 4.5%. Bank of America CEO Brian Moynihan says consumers are in very good shape. They're pretty much waving the flag that we've beat inflation and ready to roll. But yet we've got Brian Wesbury predicting recession, similar to Bob Dahl. Interesting. This is the second year in a row that he's predicted recession. It just didn't happen last year, but he continues to say we're going to have to pay the piper for the monetary policy that we've implemented. David Kelly with J.P. Morgan, he has a baseline of 2024. He says that translates to 2% growth, no recession, 2% inflation, and unemployment roughly around 4%. So that's how he boils down his predictions. But yet Morgan Stanley, they have a contrarian outlook and they're more pessimistic about the year. So there really are wide ranges of expectations depending on who you're looking at or listening to or watching. Interesting. This is a headline from Friday. The S&P rallies 1% to all-time high, surpassing previous records set in 2022. That was the first day of 2022. So the previous all-time high was January 1st, or whatever the first trading day was of 2022. So over 2 years ago. But that's a milestone that we hit Friday. And then today, this is the headline. The Dow touches 38,000 for the first time ever, notches new high along with S&P 500. So the fact that it's been 2 years, working our way back to these, previous all-time highs, I think when we look at long-term investing, tends to be positive for the longer term or even the more intermediate term. The fact that we've had this time period of downturn and then working our way through recovery.
Yeah, and so as we look out the front windshield for 2024, what can we expect? Well, as Jay just illustrated, I think it could be all across the board, but we think that recession is less likely. And that's based on where we are right now. If rates were still rising, that would probably have a more stronger signal. And keep in mind, folks, the ClearBridge dashboard of indicators that we've reviewed has clearly been in the recession column. It's a red signal, and it has been so for quite some time. But we feel like market certainly did not show up that way, and ultimately that's going to be based on corporate earnings. Inflation is continuing on its slow downward trajectory, so this is a big thing. While prices are not back to where they were, the rate of rise has gone down, and that's meaningful for the consumer, and it does show up in the retail sales numbers too. We think Fed cuts will follow at some point later this year. So the futures, as we look out towards rates on the 18-month time horizon, are actually less than they are for the 12-month time horizon. And so the economy will slow down, no doubt about it. I think that's probably a given, but we also have to remember this is an election year as well, and I've got some stats on that for you. So we would advise investors to be cautiously optimistic, maybe is the right way to put that, and prudent with your investment allocations. Again, matching your risk tolerance with your overall objectives and your goals, as well as your time horizon, is always the best way to navigate this and thread the needle. Staying invested, I think, has a higher probability of successful outcomes than trying to time the market and move in and out. Just like Tara mentioned, you could have felt good about 5% in cash on the sidelines, but you'd give up some double-digit growth in doing so.
I think it's important too, just these bullet points here, inflation coming down. Nobody knows exactly how quickly or slowly that's going to happen, but we think it is, we're pretty confident that is the continued trajectory. Fed rate cuts similarly. Interest rates are expected to go down. What does that look like over the course of the year? When does it start? Those are the question marks. And then same with the economy slowing down. How much slower does it get? Is it a 1%, 0.5%, 2% off of what we experienced this last year? So stay tuned.
As I mentioned, it is a presidential election year. If you watch any TV at all, you've probably grown sick of the commercials. But so we try to add some humor to the whole matter. The wife turns to her husband and says, "I think that's their combined ages," speaking of 2024. Biden on the left, Trump on the right, getting ready to duke it out. Not quite, right? I think Biden's 81, Trump is 77, so a bit over 150 there. But First Trust has come out with an interesting piece on the S&P 500 returns in U.S. presidential election years. And so since 1928, there have been 23 elections since that time period. And 19 of the 23 provided positive performance in the market. So this is 83% of the time for you mathematicians. When a Democrat was in office and a new Democrat was elected, the total return for the year averaged 11%. Again, this is for that election year. When a Democrat was in office and a Republican was elected, the total return for that year averaged 12.9%. And if we take a look at those years where a Republican was elected, it's 15.3% average return. And the U.S. presidential election results where a Democrat was elected is 7.6%. And over all election years combined for that specific year was 11.2% going back to 1928. So some really good history there. I think there's only been 3 negative returns over that time period, and one of them was 2008, the Great Recession. Others were coming out of the Great Depression in 1932 with Roosevelt. The market was down 8% in 1932. So most of the time it's double-digit growth in the stock market during the presidential election year. Obviously, there's many factors that influence that. It's just neat to be able to go backwards and look in the rearview mirror to see how that looks over time.
Yeah, and I think as we go into this election year, there are some important things that we need to remember, especially because this day and time, folks in general, their thoughts on politics tend to impact the way they think about other things as well. And so we want to be sure that just looking at these principles for investing during an election year, that you don't let how you feel about politics overrule how you think about investing. So those time-tested principles still apply, and we shouldn't be jumping in and out just based on our political leanings. Second, markets don't like uncertainty, but elections almost always reduce it. So one thing about an election is you at least know what you're dealing with over the next couple of years until the next election. Market timing is just as difficult around elections as it is at any other time. Definitely true. And then Greg already mentioned this too. Past performance during elections and presidencies indicates little about future results. In fact, we've seen positive markets through all kinds of power distributions in Washington, D.C. And then the economy and markets tend to fare well under all configurations of government. So exactly what I was mentioning there and what Greg pointed out as well. So I think as we head into this year, things are only going to become more front and center in terms of the election, but it's important from an investing and planning standpoint that we keep these principles in mind.
All right, shifting gears a little bit, I want to just take a few moments to talk about some items I'd like you to consider or think about in the new year. So as you know, tax forms and documents, they're starting to roll in, your W-2s, 1099 forms. Some of them you may receive through the mail, and then others, for example, some institutions are only providing electronically. I also want to remind you to not forget about 1099s from your bank in years past. Maybe your bank didn't even issue because the amount of interest paid didn't meet the criteria, but with rates where they are, I want to make sure to remind you of that. Next up is any pay increases or maybe employee benefit changes. Did you receive any pay increases? Do you need to adjust tax withholding as pay increase? Do we need to make some slight adjustments to that withholding? Next question is, how do you plan on spending those increase in funds? And then any benefit changes that your employer maybe had you elect or opt towards the end of last year. Typically those start January 1st, so we want to make sure that you utilize those to the fullest. Cash flow planning, what expenses are coming up this year? We know that expenses, while the rate of increase on specific goods is coming down, we're not expecting the price on some things, to do a 180 and shift. So we want to be planning for that. What is your current cash position? Do we need to make any changes? Are there any opportunities there? And just really, how are you going to handle from a cash flow standpoint 2024? We like to take a look at that from an annual perspective and then tweak it down, whether it's months, pay periods, things like that. Retirement plan contributions, got some exciting news towards the end of last year that in 2024, retirement plan contributions, many retirement plans have increased. And so if you're contributing through your employer's 401k, it's not always automatic that there's an increase. So do you need to go in and make that change? And same thing with IRAs. the amount that you can contribute has increased, and so do you need to make an increase if you're doing monthly contributions, or even if you're preparing to do that annual contribution, just know what that max is, so that you're able to contribute to that. And then lastly here, required minimum distributions in 2024. So required minimum distributions is the amount that you're required to take out of those tax deferred retirement accounts. And so for 2023, remember what the account values were like at the end of 2022, because that's what the R&D is calculated off of. So we saw an increase in account values at the end of 2023. So that's definitely going to cause an increase potentially cause an increase in your 2024 R&D. So just want to prepare for that potential higher income. And just speaking of R&Ds and IRA distribution planning, I do want to mention charitable giving directly from your IRA. And so there's different rules and different ages. And just note that if you are over 70 and a half, you're not required at that point, if you're turning 70 and a half in this year. I don't want to confuse those that are already grandfathered in, but just note that you can begin to contribute charitably to organizations directly from your IRA. Benefits to that is that income, if you're contributing directly from your IRA, is not taxed. It's excluded from taxable income. So it's a good way in order to give directly. And also what that helps do in the future, if you're expecting really high required minimum distributions, we can do some planning in the years before you have to take funds out of those accounts.
Those are all great things, Tara. Thank
Absolutely.
you for reminding us.
You're welcome.
And then we always like to close our webinars with just biblical wisdom and truth, and just in light of kind of all that we talked about. So whether it's geopolitical conflict or the markets, the economy, expectations, forecasts, there's a lot of stuff going around us that can be up or down, is going to change, can lead us towards being optimistic or pessimistic. But there's one thing that doesn't change, and that's encompassed in this verse here from Hebrews 13:8. Jesus Christ is the same yesterday and today and forever. And that really is he is the true source just of peace and hope and promise. And so great reminder that despite or in spite of all that is going on around us, really this is where we go to for peace, hope, and promise.
And again, we thank you for joining us. If you stuck with us this whole time, we appreciate that. These also are published to our website, usually a week or two afterwards. And we would encourage you to send them to your loved ones, friends, family, anybody that you think could benefit from these remarks. And as always, if we can serve you in any way, let us know, give us a call or email us. We appreciate the friendship and the opportunity to care for you over the years. And we'll look forward to seeing you in the future on these. And have a great rest of your day.
Take care. God
Bye.
bless.